Hello everyone, it's me the Boss Hog back with another portfolio update. It's also the first weekend of the month, so we're going to be having a look at how our wealth is going and all that other good stuff, as well as having a review of Hollywood Bowl's results. Let's do it. Okay, so things I want to talk about this week. I mentioned at the end of last week I was surprised at how non-contentious the debt ceiling conversations were, shall we say. And other than a few sort of pockets of resistance on both sides of the spectrum, it actually sailed through relatively comfortably. So, yeah, I guess I should not be quite so pessimistic all the time when it comes to my expectations for politicians. It's good news, of course, and they put a reasonably long time length on it that should mean we shouldn't have to have another similar conversation for a couple of years. I think the fact it was agreed took one of the main reasons for people still feeling bearish off the table, and sort of although it was never really expected to be an especially likely outcome, I think it was good just to put that to bed. So cool, we shouldn't have to talk about that for at least another 2 years. I also do want to talk about the US jobs report on Friday, which I think was really the catalyst for a really strong finish to the week. I guess it was interesting in that the unemployment figure went up sort of 10%, sort of 3.4 to 3.7. That was seen, though, I believe, as a consequence of people going back to work, people who'd sort of maybe been working on side projects during lockdowns or sort of had a side business and maybe now they were going back into the real world, or maybe people who'd sort of burnt through their savings and etc. etc. So even though there was a slight increase, it was seen as sort of a normalization of the job market after an interesting few years. And outside of that, the rest of it was really stonking in terms of job ads and etc. So that just showed, I think, that still by far the world's largest economy and the most important country is normalizing. So I think that was a really good thing, and I'm all for it. I also think that a lot of European countries, sort of West European countries, so the larger ones basically, produced very reassuring inflation beats. And as a Brit, I'm quite jealous. I wish we had a good central bank, and we're sort of on top of it. But it should mean that there's sort of encouraging signs for the UK, as they're still the second largest European country in terms of economy. And we will go from there. But yeah, I think it was Spain that led it, and then Germany and France. I thought Germany's was especially surprising because part of the reason why Germany looks at least as rough as the UK is because they shut down a lot of their nuclear plants, and now they're sort of having to import very expensive energy effectively. And yeah, they've got their own challenges as well. But the fact is that, yeah, all of the major European countries had inflation beats, except from the UK, which was worse than expected, especially core inflation. But again, it didn't detract from anything on a very bullish end to the week. I guess then I will be the bear in the room and start talking about the fact that I think everything looks really expensive at the moment. And it's not like at first I really had to check myself, because like when you've been beaten up and everything looks red in your portfolio and then suddenly it starts to turn greener and greener, you're like, oh, now I wish if only I'd have bought more a couple of weeks ago, right? But as I was feeling that, I was like, it's not just me, like, right? I sold out of a couple of my positions because it felt like the P's and the sort of expectations for the future were just becoming overly rosy, and actually share prices were just getting ahead of reality. And it was interesting, like when you look at Micron, they're like P of 50, and some of the other ones here, like AMD, is in like the hundreds, Nvidia likewise, like, and even like really strong companies like Microsoft looking like a 35 P, like that's starting to become expensive. 25, sure, totally justified. 30, maybe. But that kind of level, they just have to keep knocking it out of the park. And maybe Microsoft will, maybe Apple will, right? These are really fine companies. But it's difficult for me to start to just believe that everything's going to be so rosy for the next few years. Maybe it will, right? I've never been in the market from sort of 2009 and just seen this decade-long bull run. So maybe that's exactly what's about to happen. But I still think there's too much uncertainty. And I think there's a lot of the hype maybe from AI and tech is starting to feed through into the wider, certainly US market at the moment. Like I'm going to be avoiding a lot of buying additional US focused ETFs. As I touched on last week, I've got a couple of UK focused ones now, one for value, one for quality. And I think that's going to be my plan for the next few months, because just I look at this sea of red, right? And this is P's across the S&P 500. and anything in red here is above 30. But again, if you do this right on Finviz and you look into it, many of these are way above 30. And unless you're going into energy, the telcos, which honestly I'd stay away from. I've spoken about incumbent telecoms before. Maybe here some of the big banks. I can get behind the big banks at the moment. I think that makes a lot of sense. And even the regional banks, if you either do it through the ETF, which is how I'm doing it, or you have a very high risk tolerance, there's some good opportunities there. They're sound businesses. They're just at risk of a bank run, which is a high risk because you might get plus 20% in a year, or you might get minus 100%, and that's not really a risk reward I can personally get behind. So yeah, I get that PE is not the best measure for some of these companies, like Amazon especially. Here's a big standout, right? You can also look at other things like Tesla. Are they really caring that much at the moment? Probably not. But I think PE is a good measure, and the fact is that it's just, you can imagine, even expect that there will be earning upsides, and a lot of all of the semis, right, are starting to come into the beginning of a new cycle, so they're all getting excited, as well as Nvidia smashing their numbers, of course. But it just seems slightly overdone to me. It's like that American excitement sort of caught the market, I think, a little bit. And so right now I'm like a little bit skeptical that it's going to be held this high for too much longer. Of course I could be wrong. And it's not like I'm in a rush to sell any of my tech, because I don't think it's going anywhere, at least not yet. But I think it's something to just be mindful of. So I will be the bear in the room at this time, not because I'm expecting a crash or I'm shorting anything or doing anything crazy like that. I just think we need to step back and say, actually, is it a good time to buy? Maybe it is, right? And we just blindly average in. But for me, I'm going to continue to average in, especially once we get past June. But I probably will be restricting my US exposure somewhat, just because I think the market is again looking very expensive. So anyway, you'll see that I've made some moves thinking of that in my portfolio. So let's do that now. All right, so to start with, no deposits, not a huge surprise. As expected, I'm not going to be putting any more money in for the next couple of weeks. That's kind of a mid-year number of costs, some things that my wife and I want to buy, as well as, honestly, the market seems to be a little bit expensive to me at the moment, as I've touched on. Next up, we've got some dividends, so just a couple of small ones, both from ETFs, basically. They were both just reinvested back into the same fund, so not much to talk about there, and honestly, just two small ones totaling a little under £7 together. Maybe a little bit more interestingly, I decided to sell almost all. I have one share left in each of these ETFs, as you'll see in a second in both of these. First of all, with JII here. So I sold this for two reasons. Like, first of all, I think the Indian stock exchange has run up a pretty good amount. I'm primarily believing it's because of banking stocks. I'm definitely not an expert in Indian stock market, but I believe that's what I've Googled anyway. But actually, the management fee of this fund is 0.8%, which just seems really high. I was aware of this, and this is the second time I'm in this ETF. And originally I thought that was kind of cool because it had, or kind of okay, sorry, because it was different enough to other much cheaper ETFs, and I just kind of preferred it. But since then, like, actually it's aligned itself increasingly with the other ETFs in India, and I just think I can do better. So I probably will be selling out of this position fully once I'm a bit more comfortable with whatever other ETF I buy into. I still like India long term, to be honest. I just felt like it's had a pretty good run, and I was okay to take like a 6% profit for a couple of months holding is absolutely fine. So I just, and it wasn't a huge amount. I just decided to redeploy it elsewhere. Kind of similar really here with iShares automation and robotics. So this is the second time I've had this one, just because I moved it between accounts. And again, I think honestly there's a bit of hype at the moment in this kind of stuff. So likewise, I decided to sell for a similar kind of margin, and I have no problem doing that really. So again, I'll continue to add back into this, but I just felt that one or two of the other stocks that I ended up buying were actually a bit beaten down. And I think especially for HCAN here, my Canadian focused ETF, it seems to trade in quite a narrow range. So I almost kind of want to use it as a bit of swing trading. And honestly, I felt like I timed it really well. So I put my India into Canada and bought this. And then the robotics went into my Dutch focused ETF here. That's iShares AEX. I think that's the Amsterdam exchange. as well as a little bit into my infrastructure there, which is one of my more defensive ones, and it just felt like I was missing infrastructure in my portfolio. I'm actually quite bullish on the Netherlands specifically. One of their larger holdings is a payment provider called Adyen. I'm sort of surprised that that company hasn't run up even more, considering I believe it has the best sort of AI and machine learning of any PSP, including the ones that you guys know about. But actually, I think Adyen kind of flies under the radar a little bit. It is increasingly getting, starting to compete with the big boys, but it's still, I mean, miles behind the incumbents really. But like as a consumer of in my job of payment providers, it's absolutely light years ahead of basically anything else, and I'm sort of surprised it hasn't been picked up by somebody in the AI hype. But broadly speaking, I like ASML as well as a few of the larger sort of consumer staple companies that the Netherlands has and commodities. So it's a very focused top 25 ETF, and likewise, I decided that I could add to my position on a little bit of weakness, basically. So that's my buy, sells, and dividends. I'll talk through my portfolio first of all. So honestly, a really good week. It didn't really feel like it was going to start that way because honestly, the first couple of days were a bit rough, and it finished really strongly. One of the best days, sort of nudging on top 10 sort of status. Really, just everything seemed to go well on Friday. I suspect many people had a very green Friday, sort of anywhere between 1% and 3%, maybe higher, maybe lower, depending on your portfolio. But it meant that basically I'm looking at being back to 10,000 in profit, and for the first time ever, my portfolio being up of 140,000. So that feels awesome. A couple of other things were really interesting this week as well. So first of all, if I just click across here, if I can work out how to click across here, there we go. Or not. Okay, I'm just going to move that across. That will be easy. So first of all, something that was really interesting to me this week is the fact that myself, the S&P, and the FTSE 350 all managed to sort of cluster around the same sort of performance. So as I've touched on before, this is the graph that really matters to me at the moment, just because I'm trying to outperform. And so it's great to be back on top, but it's super close. And then the all world there is definitely a bit of an outlier. I've also got my graph up here working again as well, which feels good, so we can see how we're doing across. And again, this I can't seem to scroll across at the moment, which is very annoying, and apologies for that. If we just then scroll down, there is some interesting stuff where we've got 2 month end basically. So first of all, now it's good as well to see this this light blue line again. Any time that this is there, it basically means that that I'm profitable, not just with dividends. That's sort of what this means. Or if everything's below that green line, that means that my portfolio is in the red, basically. And again, part of the reason why I'm not getting too excited at the moment is because now this is the 6th time that we've gone on a little bit of a rally in what I still consider to be a bear market. And I just don't really subscribe to it, to be honest with you. I'm sort of keeping a little bit pessimistic. I don't think we're out of the woods yet, and I think this is just kind of it's kind of AI and tech hype mixed with some relief that things aren't as bad as maybe the market had expected. But for me, I don't exactly think that earnings are really reflecting of where the share prices have gone. So I'm sort of expecting this to come back down sooner or later. And to be honest with you, I kind of hope it does, because I'd like to start buying some shares again. So that would be grand. What I also thought was super interesting this week, at first I thought there'd been like a mistake for my conditional formatting. Like, for the first time ever, with the exception of Dot Digital down here, which is one of my smallest positions and kind of an emailing IT tech company, like all of my positions are not green and not red, which means that basically they moved up or down less than 5%, and I just found that really interesting. Like it was kind of a weirdly up and down week. But actually, across the whole week, at least for me personally, although here I saw, a bunch of kind of couple of percents here, a couple of percents there, nothing was actually kind of a big standout either way, which is quite rare. Like in previous weeks, I've had sort of MPW getting battered, or Disney getting battered, or, geniuses all over the place. Gamma and Amcor have had an interesting sort of year each. So it's just very interesting that actually went on a week basis. It was quite boring. It just didn't feel that way actually being in the middle of the week. So yeah, we'll see. I'm still really comfortable with my top positions here. We're going to touch on Hollywood Bowl in a moment, because I think they put out some really solid results with just 1 or 2 causes for concern, but even then, I think it was some good results. What is also nice actually is SMT here. So this is my big tech. Sorry, not even big tech. It's sort of I don't want to call it speculative tech either. It's basically 30% private companies, 70% public ones, but it tends to be in sort of quite cutting edge things, ranging from sort of Moderna and ASML through to things like SpaceX or Northvolt, so very large private companies in there as well. So this is good though. It's been really badly beaten down. I'm still about 3.5% red on it. I think I have a 720 buy price, but it's actually really moving in a positive direction now. I'm really excited to see that. And similarly as well, actually on my small cap US position here, this is now also almost green, just a slight red. I think it's 2% down. But again, both of these is fairly large ETFs in my, or funds in SMT's case. It's really exciting to see. Something else that I also wanted to talk about as well. So I spoke about Frogmorton, which is still very difficult for me to say last week. And within that, I sort of was mentioning about the fact that both that and the Fidelity Special Values one, to me, because they have very high UK exposure, there's always an opportunity that, like the UK market, which looks cheap to me at the moment, will attract some M&A interest. And one of the larger positions of Frogmorton actually got purchased, which was Decra Pharmaceuticals, which is basically a veterinary drug supplier. So for quite a chunky number, I would say, so 4.5 billion, and yeah, so not a huge position, but still like about 1.6% of their portfolio. And I just thought it was very interesting that as I was talking about this, somebody took a nibble out of a FTSE 250 company. So that was interesting to see. I would also say that just as I'm a little bit surprised that Adyen hasn't had more of a run up, I'm sort of surprised as well that Kainos isn't being run up a little bit. I think this is such a high quality company. I've spoken about it before as a really good exposure to Workday. It's Workday's main European partner, but it's highly profitable, dividend paying, a really solid company. But it also has half of the business, which is basically a software house doing exactly the kind of like efficiency and automation the businesses need and all the hype is about at the moment. So I would have thought that would have been a bit of a catalyst to push this higher. Like it doesn't exactly trade on a cheap multiple, but I think considering the potential of the business, it's got a lot of potential to run a little bit higher. And it was interesting because my only big call out this week, which is Digital being plus 12.5%. This was actually because it mentioned that it's now got some new software to improve its machine learning and AI capabilities. If I'm honest, I'm tempted to sell Digital. It's not really a core component of mine. And I think the only reason I'm not selling it is because it's a tiny position and I'd rather not sell it in negative, even though it's only worth about 70 quid as a hit if I did sell. I still think it's also an okay company, but to me, I clearly overpaid for it. Like my buy price here is like 114, I think, against pound, so 114 versus pound, and so I did overpay for it. I think I should have been paying about 80p. Now it's probably up to about where it should be. But secondly, I think the technology isn't really as much of a moat as I would like it to be. I literally last week spoke about MailChimp and Intuit, saying it's not especially amazing compared to some other providers. And at the moment, I'm getting familiar with AWS's solution, and it's miles better. And the big boys are just going to easily add this into one of their supplementary offerings, right? You just have Azure or AWS will just stick this on top of a database, and they'll just have a very easy to sell product that will knock out these kind of businesses. I think it's cool that Digital are doing this stuff, and I think they're ahead of many of the competitors. But again, I don't think that will be the case for long. I just don't think they have the scale, basically, and probably they almost want to be MailChimp, where they're a standalone company and they hope one of the big boys, like Intuit in that case, will come along and buy them, because I guess they do have some cool tech. So yeah, I worked with Digital about 8 years ago now, I think, and but now I'm no longer working with them, and I just think a lot of the other technology is kind of catching up, and they'll be taken out or forced into having a less good business in due course. So we'll see. So I may well sell that, but right now it doesn't. I haven't really got a glorious opportunity to sell it for. So we're just going to keep a little eye on that. So pretty interesting. Oh, and I do just also want to touch on Salesforce's results. So
I thought Salesforce's results were okay, honestly. I felt like it was a lot of profit taking. I know there's some concern about stock based comp for this business, and the fact that maybe the CEO hasn't quite got his head in the game, that he's sort of hobnobbing with celebs and all the rest of it. But I've just worked with Salesforce, as has my wife, and I just really like the kind of ecosystem that they've built. I think it's a cool situation, and I just think they're not going anywhere. So even though they've had a really hefty run up this year, and now I'm quite comfortably in the green, even after this sort of pullback, because it was like 222 last week. I've decided I'm going to hold Salesforce at least for the medium term and until anything changes. Like guidance maybe disappointed the market a tad, but I thought it was okay still there. I think it was mainly about profit taking, just because it's run up so much this year that other than maybe Nvidia, it's difficult to find comparables. So I'm sort of broadly speaking okay with it, for sure. I do just want to talk about my dividend situation actually a little bit. So I had a pretty good May for my dividends, but it was nowhere near as good as I was expecting. And really, the best way to show this is probably this graph. So this year was the first year where I tried to sort of plan and see how good my predictions were. And I did that using a few tools and sort of looking back at what I got last year. And basically, I believe anyway, I made a mistake with my with some of my logic, and I basically replicated Fever Tree's special dividend last year into this year's expectation, and that just didn't happen. So, like last year, I got special dividend from both Fever Tree and Aviva, which was the main driver, which explains this big bar here from 2022. So Aviva I didn't calculate in error, and I believe, although I didn't save the logic unfortunately, but I believe what I did is I basically said, if I still have an active position in that company, then take the dividend that they gave last year and apply it into this one. So for Aviva I didn't make the mistake, but for Fever Tree I did, and that knocked it out by like 200 quid. So a little bit of red face for me there with my dodgy logic. But it is what it is, I suppose, at the end of the day. So I did still have like a £300 month, which is awesome. I am still expecting the better part of £500 this month. I've got two big dividends in particular from Legal in General and Gamma Communications. Those two together are about £300. Most of my dividends come really late in the month, but that's fine. But Legal in General, I'm expecting very early next week, and I will certainly just be reinvesting it into that company, which is cool. I did also want to talk about this before we move on to some wealth figures. So actually, because of the fact that the way I calculate my yield is basically on a 12-month rolling, and last May has now fallen out of my 12-month rolling, actually my dividend yield has substantially reduced this month. And so what this now means is that moving forward, like I'm actually slightly further behind my goals than I was previously. So if you just allow me a slight scroll down my page down to here, I don't normally show this, but it's basically my previous data that I've sort of saved at the end of each month. And for the first 4 months of the year, it was going really nicely. Like if I look here against my target and how much I'm making, per hour, this is all dividend income information basically. And it's like all moving in the right direction. And then suddenly May, and by the way, like this is all just copied from May at this time. It'll get populated at the end of each month. But yeah, if we look at May here, there was actually a really hefty reduction in terms of almost going backwards 5 months. And again, I think it's really just a reporting thing where I had a couple of these big specials last May that are no longer being applied. And also, if I'm honest, I'm just not really a dividend investor at the moment. Like, don't get me wrong, eventually I'm going to restructure my portfolio and hopefully sail off into the sunset. But I also don't want to be too distracted by this number, right? Because actually I'm not using it for income at the moment. It's just kind of a curiosity for how things are progressing. And I think there are other more important things to be measuring. But I also didn't want to gloss over it either, because like I've been talking about this on and off for the last 5 months or so, because I think it's interesting and showing I was moving in the right direction. But now actually there's been quite a hefty setback, at least on the surface anyway. So my plan here though is still very much to just continue to buy assets that I believe are good. Whether they pay me a dividend or not is almost irrelevant, and go from there. Now I think what I would like to touch on relating to that is actually this here. So this is something I was doing in preparation of the half year, just to sort of get my mental capacity in order. And it was actually off the back of something I was watching. I believe it was by Graham Stephan, and he was talking about the fact that like when he first got into investing, it was all around paying off bills, right, and becoming more secure. Well, I kind of thought I'd have a go at doing that myself. It's still very much a work in progress at the moment. I think here one of my calculations has also got a bit naffed. But broadly here we've managed to pay off, our phone, some subscriptions, some streaming, some TV license, which is a fun thing if you're in the UK. And what I'm hoping to do is that over time, basically just track this and sort of pay off more and more, and eventually use that to become financially free. So I think here, this is where I have one eye on, what exactly do my dividends pay? That's kind of useful to have those conversations with my wife as well. But yeah, we'll keep an eye on that. Basically, there's not going to be any huge changes here. It's going to be, again, a 20-year project, but this is kind of my first attempt to do some of these. And by the way, just in case any of these numbers look really high, remember that I do live in sort of relatively central London, and there's a few other caveats as well for anyone who's familiar with my Discord conversations earlier this week. So then I just want to go and wrap this up by talking about wealth here. So actually it was a really interesting May where lots of things jumped. So first of all, I did a mortgage transfer, which is why this number is broadly flat month on month. But now we're back to normal every month. I'll basically, as a combination of paying off my mortgage and London house price growth, the area I'm in London at least is still growing. So this number will now start increasing probably by about £2,000 a month. So actually very significant contribution to wealth building. Also as well, where I've made my pensions quite aggressive and quite high risk, this number pings around quite a lot and actually does have the potential now to move 1,000 a day. So this is also this, depending on exactly where this finishes, this was actually running at 73,000 at parts in May, and then actually finished a bit pulled back before the start of June really accelerated it back again. So that was kind of interesting as well. I've now consolidated all my wife's pensions into a single one for Nutmeg, so that's awesome. And also I think this is a new line now that I've literally just added. So as part of sort of moving some money around, getting my new mortgage, and also not investing anything into shares so far, I decided to basically open a Virgin Money savings account and link that to my mortgage. So I have what's called an offset mortgage. So basically this money will start to reduce the amount that I pay on it. I do also have a current account linked to it as well, but for now it's just showing here for the savings account. So and what I'll expect to do is just to see this grow steadily over time. This is sort of expected to be a one-time contribution, but we'll see that add up over time. And then effectively here's some more. This is my daughter's ISA, so that's cool. There's junior ISA, but I include it in the Botthog family wealth. And so what we've actually seen is actually a very significant increase across the last couple of months, and generally things moving in the right direction. And then if I just scroll down to here, this is where sort of I'm really happy so far, because I can't really control the markets, but I can certainly control what I'm contributing into it. So the target for the year is 70,000, admittedly with a bit of a boost here from the fact that I'm a bit behind on my I haven't put anything into my ISAs yet for month to date, but broadly speaking, again, this is moving really solidly in the right direction. So this is where actually I'm most happy that we're managing to run slightly ahead of the 70,000 capital additions basically to our overall wealth. So that to me is the really important thing. So having spoken about a few weeks ago how it can be pretty tough, when you're underperforming the market, honestly the last couple of weeks have been pretty good. I've overtaken now my benchmarks, which is great. Lots of things are green, and now I'm almost getting to the stage again where I'm like, man, there's not as many bargains out there as I feel like there was, which I know isn't the right way to feel. But actually, to be honest, again, when I look at comparables, all of the stock prices and the PEs at the moment, which is my preferred metric, I know it's not ideal for every company, but it's the easiest for me to get my head around. Things look a bit expensive, so I'm assuming things are going to get a bit rough. I'm just enjoying it, a nice calm investing session for what it is, and sort of trying to build wealth and sort of catch up with some of my long-term targets. So we'll see how that goes. Anyway, that's enough, I think, for my portfolio and how we're doing so far in terms of month end and wealth year to date. So let's have a look at Hollywood Bowl.
Okay, so Hollywood Bowl. So I've previously spoken about this being the finest penny stock there is. Honestly, I still stand by that, but even if it's not the exact finest one, it definitely should be in the running. The only other comparable I can think of is Cerillion, so that's ticker pound UK stocks CER. I think that's very similarly good quality as well. But Hollywood Bowl is my pick, and a fairly large position in my portfolio, about 4% and a bit. So let's have a look at their half-year results. Now, Hollywood Bowl have an interesting year because it's basically October to September, so we're doing half year now. And there's some interesting things in the numbers first of all. So their revenue was up 10%. That's split roughly a third between basically average value per game. Even that split a little bit between bowling, which is 2.8%, and then non-bowling, which is 0.7%, so 3.5 together. And then the other 2/3 is with volume growth, basically. So that's worth noting. Now, profit is where it gets really convoluted because essentially, in this year, they no longer are receiving a rebate from the taxman in the UK, which is something that all leisure businesses received in 2022, basically to help them recover from lockdowns, right? So I think here the best number to look at is probably profit before tax, which is up 11.7%. Everything else is basically impacted by that. So you kind of have to strip that out and sort of rebase everything. So most of these numbers are taken straight from Hollywood Bowls deck themselves, but in case you're sort of reading different articles, etc., you may well see different numbers ranging from even 20% all the way down to sort of 7%, depending on exactly the measures that have been used. But I think the 11.7% is probably the most defensible in my opinion. Next up, I think this is another actually important financial consideration, which is the gross margin was actually down, but gross profit was actually up. And this is mainly relating to the fact that there was a lower share of wallet in bowling. And a lot of people imagine Hollywood Bowl is just deriving all their revenue from bowling, and I guess that's not an unreasonable assumption. But actually, only about half of their revenue comes from bowling. The rest is sort of split between amusement and food and drink. So I think what's been happening is actually their amusements particularly have been doing well as food and drink. And so it's just meant that their higher margin bowling has been having less. And so their margin overall therefore has reduced, but people have still been spending well in Hollywood Bowl centers. So that's another interesting trend actually. They remain very cash rich, basically since day one of listing, so 2016. The company's thrown off cash, and that's kind of enabled it to think about the future. So I think actually for a business of their size, they're really forward looking. And like I've been on the senior management team of a business very similar size to Hollywood Bowl, so I have sort of expectations in what I'm expecting to see from the management team and from the way the business works. And I just think they're really ahead of the curve. Like they do planning 3 to 5 years in advance, and are very strategic minded in what they do, as we'll get to a little bit more detail in a second. Now their net cash position is about 10% of their market cap, right? So it's a lot, but it actually did go down about 5 million on the previous period, and that's mainly relating to the opening of 2 additional sites, which cost about 3 million each to open a site. So that's basically the net there. In terms of their divvy, so they reaffirmed their dividend policy. Basically, they did pause and actually stopped, to be clear, their dividend during lockdown. I think that's perfectly defensible. But since they listed in 2016, outside of that window, they've had this policy, which is they pay out 50% of profit as dividend, and they split it in the same way that most UK listed companies split it, which is an interim and a final. And they do the most standard way of doing that, which is 1/3 in the interim and 2/3 in the final. Now, last financial year, Hollywood Bowl actually did a special dividend as well of about 3p. And a lot of people don't realize as well, but I mean, Hollywood Bowl at the moment is like a 5% dividend stock. It's kind of goes under the radar because you look at it as like a penny stock or a growth stock, but it just throws off so much money. And I think that's one of the reasons why I like bowling so much as a leisure activity. Like it's cheap, it's affordable, but it's really high margin, and it's not particularly easy to replicate at home in a sort of real way. So for me, it's very difficult to replace, but still representing a great place for people to go and seek value entertainment. So I kind of like it. I think it actually has a very defensible niche. There are other bowling companies, but I think Hollywood Bowl is my pick. I just think it just reeks of quality, basically. So they moved their dividend for the interim up 9% from 3p to 3.27, and yeah, reaffirmed it. So really, in terms of your dividend or growth, the way that you look at Hollywood Bowl, I actually view Hollywood Bowl as a growth company, just because like the dividend, although I expect it to increase quite materially, is really a reflection of their EPS. So and they should basically grow parallel with each other, right? So whatever their EPS is, but you're basically going to be getting 50% of that as your payout, and that's then going to translate into the dividend that you're going to be getting. So that's the expectation I would have. It's also interesting to me that CapEx is as high as it is. So this 18.9 figure, again, this is only a 450 million pound market cap company, right? So and in 6 months they spent 20 million pound on CapEx, a lot. And they set expectations that 10 million is also going to be spent in H2. It's really just because they're investing across the board. So first of all, they're putting solar panels onto all the sites that can have them. Currently, 38% of their centers have solar panels. They've also invested heavily in pins on strings, which is basically, I mean, it is what it says really, but what it means is that games can happen quicker, and so they ties into more volume and more spend on average. So it just enables you to stack the pins a little bit quicker. They've also done 8 refurbs, and incredibly, their refurbs bring in a return on investment of 55% on average, which is just astonishing to me. These kind of return on investments are absolutely incredible. And by the way, new sites are coming in currently at 35% return on investment. So again, huge efficiency metrics in terms of financial strength, which is just impressive. Also as well, waste recycled here at 81%. Also, because of the fact that they plan years in advance, their utility bills are hedged until the end of 2024. And what this means is that today, the utility spend is about £1.5 million or 1.4% cost of revenue. They're also in the process of hedging to 2025. So again, this is something where they just haven't seen the same increase that maybe other businesses have as a result of their forward planning. They also regularly win awards, so they again won the top 25 best places to work in the UK, and they remain the #1 retail employer in the UK on that same measure. So I think that's also impressive and worth calling out. And lastly, as well, they they publish things like 55% of all their managers are promoted and those kind of things as well. It's very clear that they take pride in that, and I guess if that's a consideration for you as an investor or as a human being, that might be something for you to consider as well. They did identify some cost pressures, so labour at 8 to 10% inflation. That's sort of what I'm expecting, honestly, at the moment. Food and drink likewise, although a little bit less, and they've made some tweaks to their menu just to sort of manage that a little bit. I did think the last point about capital goods inflation was telling. So that they're actually estimating this is running at 16% inflation, and although they didn't exactly break it out, it seemed to be it was like the cost of construction, so materials, etc., were related to that, and they talked about approaches they were exploring to try and manage that a little bit better, so hedging or storing that material, etc., etc. But yeah, that kind of increased the cost of opening new sites from sort of 2.6 million to 3 million. So a pretty big increase, really. So definitely something to keep an eye on. But for now, I think it's okay in the scheme of things. In terms of the size of the business, so they have in the UK 69 active sites, although 4 of those are putt stars. And I guess just as a bit of a segue, it's always felt to me like, and I've been in this business now for a couple of years, it's always felt to me that Hollywood Bowl didn't really know what to do with putt stars, and they've been running a couple of trials actually, of the concept, and it feels like they've finally worked out what they want to do with it. They've kind of worked out replayability and difficulty levels and different paths and etc., etc. And previously, putt stars have basically been a standalone concept, but it seems like they're revisiting that, and they're going to start adding sort of 9-hole courses into bowling centres. So they've got a couple of these lined up already over the next year. So it'll be interesting to see what that does. Now, their return on investment of putt stars is much lower than bowling, and I wonder if they almost want to see it like as a supplementary service, similar to like amusements. So again, for me, it'll be interesting to see how that pans out. Like, is this just a distraction away from the much higher margin bowling, or is this actually a really good thing? And like for me, I think like if I was to go to a bowling centre, I would be tempted to go and have a game of golf as well, but I probably wouldn't go just to play the golf. So I can see that might be a more sensible concept, and we'll see what that looks like as it feeds through. And again, like they're very data driven company as well, for like a stuffy bowling alley, as you might imagine, but they're not like that at all. Incredibly dynamic and forward looking. So I'm expecting that they've done a lot of data and research into this, and they're making smart decisions. They've already got an additional 9 centres signed. They like taking long leases on sort of marquee spots in large developments. The one I go to, the Hollywood Bowl Centre I go to, is in Greenwich, and it's in the O2 Centre. And it's cool. I like it in there. My daughter especially loves the amusements, interestingly enough. I'm not even sure it's really aimed at a 3.5-year-old, but I totally get the concept. It works. I mean, and that place must absolutely bring in money. So it's cool. And another 15 identified. And then in Canada, so they've now got 9, and they have signed an additional 1, and they're looking at an additional 30 as well. They also spoke quite a lot about the work that they've already put in place in Canada. So they've now got their senior management team in place. They've seconded some of their best centre managers from the UK into Canada to help that grow.
and they're basically making sure that they continue their wholesale basically supplier that they acquired excuse me, sorry, as part of their acquisition previously. So that remains a focus for them as well. Canada is running ahead of plans, and although here it's doubling in a year, it's worth pointing out that those comparables still have an element of lockdown in them, just because Canada was about 8 months later than the UK coming out of lockdown. So a better comparison here is against 2019, and there we're seeing sort of a 35% growth. So again, solid growth, and it's generally considered that Canada sort of as a market needs a bit of a revamp, and so potentially a big opportunity for Hollywood Bowl there to grow the way that their business looks. Yeah, so again, just incredible numbers, really. I've already spoken about this, but I just think that's amazing. I've spoken about also in previous videos just how genuinely digital the business is. Like, I'm really skeptical every time I hear things like digital and digitalization. Like, I've heard the buzzwords loads for years, but the way that they have like over 1 million customers and people in their CRM. Like, they have dynamic pricing, so they can sort of really tweak the pricing on supply and demand and those sort of things. 60% of all their sales are now online, and they're actually building their own platform. And again, just like in standard Hollywood Bowl plan years ahead, they had their development team in place for this last year. So they've basically had 2 years of a dedicated development team in place working on a proper bowling software that they're going to be doing, because they couldn't find something that did everything that they wanted off the shelf. So they spent 2 years building a centralized CRM system specifically for bowling, which again is just awesome, really, to think that's what they've done. I mean, maybe you could say that's a distraction from the core business, but on the earnings call they made clear that there just wasn't the software out there for them. They're basically having to build it, and it will be interesting to see if there's an opportunity to sort of then sell that into the wholesale channel, seeing as they've already got their wholesale provider anyway. So we'll see. I don't know. It may well just be an internal piece of kit. But I have no doubt at all that they'll be able to leverage that to basically optimize everything, because that's what they do. In terms of EPS, so their EPS this year, this quarter, you're looking at this half, you're looking at a smidge under 12p. Last year it was 23, and I'm sort of expecting about 25p this year. I think the tax will basically keep a lid on it, but I'm sort of expecting maybe a 10% increase in that EPS or something along those lines. Trading is a bit all over the place. It did run up on the earnings, which I think was deserved, but I still think, having priced this previously at 310, and mainly because I put a bit of a cap on the multiple of it because it was still recovering, I wasn't sure what it was going to look like. I've actually decided to significantly increase my price target and sort of put me actually in the mid-range, or maybe even slightly on the upper end of analyst averages at the moment. Beforehand, I was right down at the bottom of analyst ranges. Now I'm sort of in the middle, or even in the sort of top half. Although I do expect many analysts will sort of catch up and be moving their price target up as well. And really, it's the change in the multiple here, I think, is the main thing. I just think it deserves a 15. Before lockdown, it was trading at 18, although again, it's difficult to really use that because it's so new and everything else. But to me, although it's still quite a small business, I think it's now like showing maturity and stability. Even though it's still growing, it just, short of another lockdown, I just don't really see much to stop it. It's just going to continue to throw off cash. There's a very clear sort of revenue to cash here, and a very clear strategy that just makes a ton of sense. So I think it deserves that sort of flag of a mature business, and so I think it deserves the multiple, honestly, for sort of consideration of all things considered. So I basically here just done 25 times 15. I accept that the 15 is pretty arbitrary, and even the 25 is crystal balling, although I think that's a lot more defensible. But yeah, the multiple is always up for debate, right? You might look at this business and say it's just a bowling alley. It can't have a multiple of 15, which is fine. I can respect that. But likewise, you might look at a growth business and be like, yeah, that should be like a 25 multiple. You probably don't, but I think 15 is where it should be. I don't expect to change this multiple anytime soon unless something really starts happening. But yeah, so I think we're going to go for 375. I will be reinvesting everything I get from them. Unfortunately, because my wife works for a private equity company and I have restricted trading, I can't buy more Hollywood Bowl. Otherwise, even at these levels and being up sort of 25%, I would absolutely be interested in buying more of them. Of course, do your own research. Tell me if you agree, disagree. Any other really fine penny stocks maybe that you're aware of that you want to call out? That'd be an interesting one as well.
Otherwise, that's all I've got to say on the matter. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.